We start the show with breaking news. The Bank of Canada making its trend-setting interest rate decision for the third time in 13 meetings. They are keeping their interest rate steady at 5%. We are seeing the Bank of Canada issue its trend-setting rate decision for the September meeting, keeping the rate at 5%. That's exactly what was expected this time around. This as inflation is still sitting above target. Headline inflation coming in at a range of 3.3%. You're seeing the Canadian dollar basically neutral to this event right now. The Bank of Canada keeping its trend-setting rate at 5%. Of course, the question will be, what happens next? Are we done? And for that, let's bring in our power panel for the hour. We've got Jim Thorne joining us from Wellington-Altus Private Wealth, Ed Devlin joining us, formerly of PIMCO, now CD Howe, and of course, Earl Davis joining us from BMO. I'm going to dig into the details, but Ed, I'll kick things off with you. No change. Is that as expected? And what do you expect next?
Yes, that's definitely what the market was pricing, and I think we're probably, I think we're probably done. But I think people who have too much conviction around that, any view, quite frankly, are maybe being a little bit foolish, because I think that there's so much uncertainty out there that, can we re-engage inflation? The preferred measure of the Bank of Canada's inflation, which is this core inflation, ex housing, is still sticky around 4.2. So we're not out of the woods yet. So I think probably, but wouldn't bet the farm.
To that point, Earl, I'll bring you in on this because I think this dovetails with your view on where rates are going. The Bank of Canada says they're concerned about sticky inflation and they're prepared to hike again.
Yes, and that's correct. We didn't anticipate a hike today. There's 2 more meetings before the end of the year. We anticipate they're going to hike it, one of them, at a minimum.
Now, this is where we bring in Jim, because you have long said that enough is enough when it comes to the rate hikes. When you strip out various parts of inflation, the job is done.
They should be cutting.
Cutting.
Yeah, Tip Macklin is going to go down in history as the most hawkish Bank of Canada head ever. More hawkish than John Crow, more hawkish than Paul Volcker. And so what I would just say is what I do is I ignore, because of all the seasonal adjustments that have happened by the BLS and Stats Canada, I look at data that is not affected by seasonal adjustments, even though, which it blows my mind up here, is that 30% of CPI is created by interest rates. Interest rate hikes do affect the supply side. San Francisco Fed just came out with a major paper yesterday on this fact, but it's ignored up here. I don't know why. That
interest rates are driving inflation through mortgage costs?
Long-term effects on total factor productivity and economic growth is detrimentally affected by extreme rate hikes. That's the San Francisco Fed, not me.
But hey, that's a feature, not a bug? Isn't that what we're trying to do here, Ed?
I agree. It's the feature, not a bug. They know what they're doing. It's So put it this way: you can have an intellectual debate about what they should or shouldn't do. My old boss at PIMCO used to say, "Don't tell me what they should do, tell me what they will do, and get ahead of it." And so, the fact of the matter is, the Bank of Canada is looking at these measures, and if you have a sense of where that is, then you'll have a sense of where they're going.
Well, then I would counter with this. I look at real GDI. Real gross domestic income. Never, since 1970, has a central banker hiked when GDI is negative. 12-month GDI in this country is negative 4%, precisely negative 3.9%.
But you're looking at the wrong thing. The thing
no, I'm not. No.
Just let me explain. The thing that the central banks are looking at is not growth. They're looking at inflation. We've gone through many different types of inflation: supply side shock, fiscal driven, monetary driven. You know what's driving things now? Wage inflation.
Hold on a second.
This is the most dangerous part of wage inflation. But we're seeing the numbers. Look at what the pilots are getting. Look at what UAW is asking for, like the auto workers. And what they're trying to do is say, listen, we're adamant we're going to get inflation back down to 2%, so you don't need to ask for 5-6% wage hikes. 3% is good. You'll still have a real wage, and that's what they're focusing on.
6 months of successive downward revisions in labor data in the United States. June data has been downward revised to 105,000. There is over 1 million million jobs that have been created this year by the birth, death assumption. So traditional sell-side status quo people in this business have this point of view. At Wellington, we're an independent, worked in the States for 20 years. I have a PhD, right? And if you're sitting there and saying you want to hike rates with real GDI at -4%, then Canada is going to have a hard landing. That's all I'm saying.
Yeah, right now I think 2024 is going to be an all right year for Canada. If there's any type of landing, it's a 2025 story. But again, you got to focus on the central bank playbook. And what you're reflecting is what a lot of the market's reflecting. They're discounting eases next year. I don't see any eases in the market. I think they're on hold. And the reason why they're discounting eases, there's two playbooks out there. The growth playbook, that's been the central bank playbook of the past 20 years, pre-COVID, and the inflation playbook. That was the playbook of the 70s and 80s. We are in the inflation playbook now, and that's been evident over the past 2 years, all the hikes.
So
I know you guys disagree on this.
2% is a magical number, right? Is there a universally agreed upon CPI number that every central bank, you just came out with a number, right? I mean, look at what the New York Fed said yesterday. Hey, if you use the harmonized number from from Europe into the United States, 1.7%. Hey, let's use Paul Volcker's CPI number, 1.2%. So what we do at Wellington is we don't take the view, what are they going to do and accept it? We sit there and talk to our clients, and we manage money and saying they are going to make a massive policy mistake.
It's an art, not a science, right? And so, yeah, the number's not perfect, and you can torture it to confirm your view, and you can torture it to confirm your view, depending on what you want to look at. But the everyday person is struggling. They don't feel like they're rich with getting a 5% raise because they still can't buy a home. Their gas prices are still out of control. The grocery bill is still out of control. That person doesn't feel rich, even as the Bank of Canada is saying wage growth is still too high.
Yeah, and I agree with you. And we have to remember, the central bank, their base case, they do not want to hike. They see the damage going through the economy. They see the pain. The reason why they're hiking is if they don't hike now, what they've done cumulatively, they'll have to hike more in time, and the pain will be even more.
The largest component of CPI is mortgage interest costs.
Okay,
Rate hikes are inflationary.
I'm going to say
what is so difficult to understand about that?
I've pointed that out, but that's just a function of where we are right now. Because if you say, it's year over year. Of course, they took out these unprecedented rate hikes. Had they not done that, the other components of CPI would be out of control.
Disagree. Nowhere in economics does it say rate hikes solve exogenous shocks.
But they're the ones in charge of it.
Robert Solow, Nobel Prize winner, said Paul Volcker was willing to burn down the house to roast the pig. Tiff Macklin is more aggressive than Paul Volcker. And so, what you guys are saying and accepting is the fact that it's okay for Tiff Macklin to burn down the Canadian economy. I disagree.
Tiebreaker and Devlin.
Okay, shall I refer to you as Dr. Jim?
Dr.
But
Thorne?
anyway, so let's put it this way. I tend to have a sympathy for your view. I like bonds, and I think through this period of noise, and we've got a period of noise going on, we are going to have created too much destruction, and we will come out the other side with much lower rates. So I've got a fundamental view that agrees with yours. I think in terms of calling Tiff, I think Tiff is doing a brilliant job, okay? And here's the thing, and you can argue the following. Far too accommodative. Everyone, that's now with the benefit of 2020 hindsight, we would say all the central banks were far too accommodative during the pandemic. But what was the left tail risk? Deflation. You know what? This isn't the worst case scenario. The worst case scenario was deflation, and we avoided that for now. Now, there's always I said for now. Now, if you look at, we've now hiked rates, real interest rates, 10-year real rates. We can look at Canada, the U.S. Let's look at the U.S. more liquid. Have gone from -1% to +2%. Okay, and Canada is slightly different, but almost close. If you look at break-even inflation rates, so that's what the difference between inflation-linked bonds and nominal bonds, and that's kind of the market's measure of confidence in the central bank, they're both sitting around 2%. The U.S. a little higher, Canada a little lower. That is almost the textbook perfect definition of applying a lot of tightening and not losing your credibility as an inflation targeting central bank.
So you think?
So I think you're wrong.
No.
In calling
So you
them like
think?
That.
So let me just get clear.
And I've been around.
So what you're
Go ahead.
So what happened to long and variable lags?
Exactly, I agree with you. And
No. You can't have it both ways. Talking both sides of your mouth.
I did not. I said there's an unprecedented amount of uncertainty.
So you're
right now.
saying that the interest rates, you're saying that the inflation drop that we're seeing right now was affected by monetary policy from central banks. You are basically just thrown out long. You just said everything. He's done a wonderful job.
I told you what break-even inflation rates were. I didn't say that. Don't put words in my mouth. So they're telling
you said he did a wonderful job. He hasn't done anything.
They have retained the confidence of the bond market, and the one thing you want to do is that, because if you lose that, then you'll end up with huge break-even. You will have more damage than you're even talking about.
You can't seriously think that this whole rate hiking campaign has been a mistake.
Alan Blinder in 1982 wrote a paper about Paul Volcker basically saying if he just would have sat there and done nothing and allowed the supply shocks to work their way through the system, we would have come up to the same endpoint. All I'm doing is trying to apply theory. All I'm saying is with gross domestic income, that's a coincident indicator. GDP is a lagging indicator.
I agree with that,
so you guys want to be apologists for central bankers, and that's okay.
I think a key thing here.
Saying that.
A key thing here, Jim, is what I'm saying is I don't necessarily agree or disagree with the central banks. I'm just saying what they're doing. I'm not an economist. I'm not a strategist. I'm a risk taker. We have been putting risk and betting our money the way we see the bank going over the past 2 years. This year, you know what? We have extreme outperformance. Top quartile across a number of our funds because we believe they're using the inflation playbook. I'm not saying it's the right one, and I do agree eventually bond yields will go down. I just feel not overnight rate, but 10 to 30-year bonds are going to go higher before they go down. Time-wise, that could be a quarter or two. So we're close to the end time-wise, but we'll see.
And you know what? There's so many variables. Look at quantitative tightening. Mm-hmm. Have we really seen the full effect of that yet? So they're still long. They're still variable. They're more variable than I've seen in my career, and I've been doing it a long time. And I agree. My thing is not to apologize for anyone; it's to make money for your investors. And I think, when you apply, the market, you have to respect it, and from time to time, you have to take the other side of it. And right now, I think bonds look attractive.
Okay, we're going to